All right, so welcome everyone. This is Kaylyn Kaylyn is a licensed CPA from Hall CPA, also known as the Real Estate CPA. They do all of our taxes for all of our underlying entities, for our private equity funds, for our personal tax return. Just really have a great relationship with the firm and with Kaylyn. Kaylyn and I are in communication probably at least once every 48 hours, sometimes once every 24 hours, depending on the time of the year. Certainly in the last several weeks, it's been a daily thing getting all of our K-1s out. So Kaylyn is here to teach us about K-1s, more from just sort of a holistic perennial information about what is a K-1, how do you interpret it, what do those numbers mean, and then at the end we'll have some Q&A if you have specific questions about how to interpret your Q&A or questions that you have about any specific fund or those sorts of things. Take it away, Kaylyn.
All right, thanks, Elaine. Thanks for the introduction. You stole half of my intro there, but I am Kaylyn Deaver, a CPA and a tax manager here at Hall CPA, also known as the Real Estate CPA, as Elaine mentioned. So today I'm joining just to host an investor webinar regarding everyone's favorite topic here of the month, especially in April, taxes. So try to stay awake with me. I promise it's only 30 minutes and then we'll get you guys out of here for lunch. But I lead a team of partnership specialists, and around 80% of the work that we do throughout the year is specifically with fund managers such as Nick and Elaine. So we're really well versed in large syndications such as this and those that they're running. Our firm, the Real Estate CPA, we work solely with real estate investors. So day in and day out, we are working with people such as Nick and Elaine, and then also individual investors. So we have teams that specialize in strategy, accounting, and of course, tax compliance, both individually and for entities. So as Elaine mentioned, I'm going to take just the first probably 8 to 12 minutes here to walk you through a K-1. I'm going to point out some key items to watch for, be aware of. And then I'm also going to take a few minutes to walk you through a cost segregation study because they're every real estate investor's favorite thing right now. So I just want to point it out, and that way you can see what these look like. After that, we're going to open the floor for questions. I know a couple of investor webinars I've hosted before. That's generally the best part. So looking forward to that and looking forward to what kind of questions you guys have. And then if you're solely a passive investor, so this is going to be beneficial for you, just so you have a better idea of what's going on behind the scenes, what's impacting your K-1s each year. But also if you're a real estate fund manager yourself and you just happen to invest passively with Nick and Elaine through their fund, but maybe you have a few doors yourself, this is going to be beneficial for you as you work with your CPA to maximize those tax strategies for yourself and maybe other funds that you run. So with that being said, I'm going to share my screen. I'll walk through a K-1. And full disclaimer here, it is a test. It is a dummy K-1. So we're not seeing anyone's identifying information, but we'll start with a K-1 here. So this is for the 2022 tax year. And a couple of items that I want to point out that you should be looking for and confirming are correct on your K-1 when you receive them every year. Big items are your social security number, which is going to be here in box E. If you invested through an entity, you'll have a taxpayer identification number. It'll be an EIN format. So the format's just a little bit different, and that's what you should see here in box E. So you want to make sure that's correct each year, because that's what's transmitted to the IRS. And that's how the IRS is matching your personal K-1 with your tax account. And just to confirm, Elaine, you can see my screen, correct, with a K-1? Beautiful. Okay. So next, you'll notice your name, address, city, state, zip is in box F. And you do want to confirm that this is correct, right? Because you want your name on your K-1. But at the end of the day, this information is purely just that. It's informational for the IRS. They're not matching it line by line the same way they are your social security number. So if you change your address throughout the year, it's not a big deal. We're happy to update it. Shoot Elaine an email. We'll get that updated in our system. But don't worry, nothing to be worried about or keep you up at night if your address is incorrect. Truthfully, we could put Disneyland's address on here and the IRS is still going to receive it. So you're in the clear there. Next, just more informational items here. That you're a limited partner, what type of entity, you're an individual, or if you invested through an entity or an IRA. We do want to make sure that this is correct as well. If you invested through an entity or an IRA, 401k type, because that affects state withholding on the back end. So just another item to pay attention to, that if you invested through your entity, we want to make sure that that's captured there. Next, partner share of liabilities. This actually isn't something that you should be aware of or super concerned about, but this is something that stands out to me and actually something that Elaine and I had a call on a couple of times throughout this year. And so the reason I'm bringing it up here is if you're invested in other partnership syndications, what you should be looking for here is an amount called qualified non-recourse financing. And that's when the mortgage is secured by the entire partnership. However, Nick and Elaine secure these mortgages themselves. So that's why you're not going to notice it on your K-1s coming from the funds. You want this number here to give you basis. However, you guys have basis because you're limited partners and you contribute. And so this is just really rare. We only have one other partnership group or fund here at the firm where the fund managers actually guarantee the loans. And I say that's rare. It's truly quite amazing, right? That your GPs are willing to take on all of that liability themselves. It's not something that we see often. A lot of times what we see are GPs raise money and the partnership secure the loan in total. But Nick and Elaine, they have secured this loan. And so that's why you're not going to see these amounts here. If you have another K-1 that you invest passively with, you should likely be asking because odds are the GPs did not secure that. It's not often they do that. It's truly, like I said, it's quite amazing. I had to call Elaine several times throughout the year and I say, are you sure? Are you sure? And sure enough, we go through the loans and her and Nick really did guarantee those loans. So it's great to see that they have skin in the game, truly.
Mm-hmm. That's why we have such good interest rates. In case you're wondering, why do we secure the loans? It's because that typically, I say in our area, that results in probably a 0 to 2 points lower interest rate.
Yeah, fun conversation on interest rates earlier this week.
Yes, yes. Kaylyn, there was a request if we can zoom in a little bit more on the K-1 as you're going through.
Yes, certainly. Okay. Next things that you should be aware of and definitely checking each year, capital contributed during the year. So if you put money into the fund, you want to be sure that that amount is reflected in your on your K-1. And so it should match the investor portal. Same thing with withdrawals and distributions. If there's an amount here that you did not receive, you should certainly be asking questions. Vice versa, if you did receive an amount, have high integrity, right? And say this wasn't reflected. And yeah, it's just things you want to be aware of because it is your funds coming into and out of the partnership. So next we'll dive over here to the right side of the K-1. So everything on the left side is purely informational. It's just your information. But then on the right side of the K-1 is where all the tax magic happens. So this is the right side is what is going to affect your individual tax return every year. You'll see ordinary business income and loss is blank. It is generally 0 for real estate partnerships. However, something to be aware of when the fund liquidates and properties sell, because we did take bonus depreciation on these and you recognize that benefit up front, a portion of this bonus depreciation is subject to ordinary income tax rates when it's recaptured on the back end. So if you see an amount here in ordinary business income in a real estate partnership, odds are it's because the property was sold or one of several properties were sold and you're recapturing a portion of depreciation. Most of the time, you'll just have amounts here in box 2, and you'll see that's where your losses are flowing through. I know we won't dive into it too much, but there are some passive activity loss rules, right? So if you're a real estate professional, this can offset your ordinary income. However, if you are a passive investor and you are subject to passive loss rules, this may be locked up, but that's not a problem because it's just locked up and you'll use it in future years when you have income from the partnership. So if you had this $33,000 loss this year and it's locked up and next year you see $60,000 of income, on your individual tax return, you're only looking at around $30,000 of income, right? Because it would offset next year's income. So another item that you want to be aware of are short-term capital gains, long-term capital gains right here in box 8 and 9. Again, you're generally only going to see those when the property sells, which is why you're not seeing those this year. So just something to be aware of as we start looking to sell these properties. I know Nick and Elaine are holding them for a couple of years. You don't have to worry about that too much here in this fund, but I know you guys are probably invested in other funds as well that might be liquidating. Next is box Z, code 199A. And so a couple of years ago, with the Tax Cuts and Jobs Act, 199A became a big deal. And it essentially gave pass-through investors an additional deduction. And so you just want to make sure that you're receiving this 199A on your K-1. Again, it's informational, but it's going to benefit you on your individual tax return. So all of your partnership investments, I say all, 99% of your partnership investments should have box 20 code Z. It's kind of a freebie benefit that the government gave you essentially. Lastly, on K-1s, I just wanted to dive into a couple of states because you'll probably notice you have a lot of state K-1s this year and you're thinking, why? Nick and Elaine only own properties in Washington and Minnesota, and Washington doesn't have a state income tax, right? So most states, I said most states, many states require if you just have one resident partner in that particular state, the partnership fund has to file. The reason they do that is because when these K-1s get transmitted, your federal K-1 is transmitted to the IRS. The IRS has that on file. But if you live in New York has no idea that you're invested in this partnership and you may be receiving income. So New York puts that burden on the partnerships to file and essentially let them know that, hey, there are New York investors here. However, if you're not living in one of those states, that K-1 is going to be blank for you. It's going to be zero. It's not going to show any income source to that state. And that's the part that you really care about, because that's going to relieve you of filing those additional states that they're immaterial. They don't matter. You don't need to. So your individual CPA will have details there and they will know your specific tax situation. But what I wanted to highlight for you here is specifically for Georgia and provide an example. You'll see that the Georgia ratio is 0. If this partner lived in Georgia, this would be 100% because Georgia is saying you live in this state, we're going to tax you on it, right? But this partner doesn't live in Georgia, so it doesn't matter to this partner. So you'll notice there's 0 and total Georgia income is going to be 0 as well. And I've got another one here as well to show you for New York, very similar. You'll see this amount is tying back to their federal K-1. It reflects the federal. But for New York, this partner doesn't live in New York, so it doesn't matter for them. You can honestly have a bonfire with it. It's just informational. Unless you live in that state, you don't need to be concerned about it. So the ones that you do need to be concerned about are going to be Minnesota, and that's because the properties are located in that state. And so work with your individual CPA to determine if you want to file. Most CPAs will do a cost benefit analysis because I know filing in additional states does cost you money, right, for your CPA to file it for you. However, when you're generating losses, what you likely want to do is lock those losses in at the state level as well. So as we talked about with your federal losses being passive and suspended and then offsetting future income, if the loss is material, you're going to want to do the same thing at the state level, and then you can offset your state income in future years. So you'll see that the Minnesota K-1s actually have amounts here, and that's because the partnership is located there. So even though this partner is not a resident of Minnesota, it does reflect that they have income there because that's where the property is located. So I'm going to pause there for just a minute. Any particular questions as we just walked through K-1s before I dive into the cost seg study? Okay, let's dive into a cost seg study. And so this cost seg study was actually related to Fund 1. But what I wanted to show you is a cost seg study and what you can generally expect the benefits to be from a cost seg study. So when you acquire a property, you're going to break out the portion related to building and the portion related to land. And those two amounts can be found from the county's tax assessor website. The IRS has ruled that that is the most reliable source, and that's the percentages of breakout that you should use. But the building piece itself is going to be depreciated over 27.5 years. Land is not depreciable. It is never depreciable. It will not be depreciable. So just know that land is not depreciable, but your building itself, that piece that is broken out, is going to be subject to 27.5 years. So you're taking those benefits of depreciation over 27.5 years. But what cost segregation studies allow you to do is it allows you to accelerate bonus depreciation. So someone will walk the property if it's a large multifamily property, an apartment building, or for smaller single family homes, you can produce these reports online. You don't have to have a full walkthrough. But what happens is someone will walk the building and they'll say, okay, the building itself might be 27.5 years, but what about everything inside of it? What about the cabinets? What about the appliances? Those truly aren't 27.5 years. Nick and Elaine are going to have to go in and replace those refrigerators and those stoves and those washer and dryers in the next 5 to 10 years. So a cost segregation study will break out individual assets and you can accelerate depreciation. Generally, what you can expect from a cost segregation study is accelerated depreciation of somewhere between 20 to 30%. 30 is pretty aggressive. We don't see that often. 20, honestly, we've even seen as little as 15%. But in this case, you can see, and I'll zoom in over here, this cost segregation study produced right at 20% of accelerated depreciation that the fund could take advantage of and pass through to all of its investors in year one. So the only amount then related to 27.5 is going to be the 80%. The other 20% we took 100% bonus on, right? Now, these are beginning to phase out. The tax code changes yearly. So this year in 2023, bonus depreciation is going to be at 80%. So what you would do is you would take the 20% and multiply it by 80% to get the benefit that's flowing through to investors. But 2021 and 2022 were great years, 100% bonus depreciation. So, I mean, it was literally dollar for dollar here of the results that the cost seg produced, passing through in depreciation benefits to you guys. So this is something to be aware of as, you know, if you're a real estate investor yourself and you're managing a property, you may want to consider a cost segregation study yourself as well to accelerate depreciation there. So, any additional questions on cost seg studies? Okay, well, I'm just going to open the floor for questions. If you guys have any questions, got around 15 minutes for free CPA advice. So go for it. I'm here for you guys. What about California investors? No accelerated bonus depreciation. Correct. California does not recognize bonus depreciation, and a lot of states do not. In fact, I will share my screen with you again, and I'll show you Minnesota as well. This Minnesota K-1, you'll notice that there is a second page attached to your Minnesota K-1. Most states do not conform to bonus depreciation. I think I could count on one hand the number of states that actually allow bonus depreciation. So that is mainly a federal benefit. And at the state level, you're required to add it back. Now, every state is different. It's not the same add back for each state. Each state may calculate it differently. So on your Minnesota K-1, what you'll notice is a walkthrough that shows you exactly how much bonus depreciation made up your loss for the year, and then the respective add back. And so if this partnership did not have to file in California, but if they did, you would see a very similar result where this $9,300 is the amount of add back for the year. So similar on your California K-1, it would have an adjustment there. And so it would start with federal, and then it would show you the amount of add back, and then it would show you your state portion.
Kaylyn, I think what might work best so that the recording is good for the future is I can read out the questions, and then certainly whoever's question this is, the security is allowing you to unmute yourself. So if you want to, you know, ask or, you know, kind of dialogue with Kaylyn around your question, feel free to do that, but I'll just start reading them. So someone asks, this is a question about the liabilities section. If there is recourse under Section K under partner's share at the beginning, but not at the ending, does that mean that I actually had recourse in my name or the name of what the investment was under at the beginning of the year?
Yes, so that's how that works. What was reported on your prior year K-1, it rolls forward automatically to your beginning of year K-1. So yes, you would have had recourse at the beginning of the year. I will say that, again, recourse is not something that we commonly see. So if you're seeing that, it could be that last year it was flagged as Q&R, and this year, you know, someone went through the full loan document and realized, okay, this isn't truly Q&R. It's not secured by the partnership. It's actually secured by one specific person. And so it could be just that amount was updated.
What was Q and R again?
Qualified non-recourse.
Got it. Thank you.
Yes.
Someone asked, will the cost segregation study be posted to Invest Next? That's probably more a question for me. No, there's no plan to share out the cost segregation report. All of that information funnels up to our CPA level, and then they put all the numbers into the right spots on the K-1. So individual investors shouldn't need to have those cost seg reports. Next question is, as an accredited investor living in Minnesota, participating in syndicated multifamily real estate investment in a different state, specifically Arizona. So just to clarify for everyone, this would not be Black Swan because we're not in Arizona. Do we need to file Arizona state tax return individually if a composite Arizona state tax return has been filed at the company level for this investment by the GP sponsors of the investment? Schedule K-1s received do not include any information specifically for Arizona.
Yes, so I would say I'm always going to give the disclaimer of your specific situation. You should talk with your individual CPA. However, a very general response to that would be when composite returns are filed, the partnership has taken care of that filing requirement on your behalf. And so generally there's no additional work needed on your behalf or your filings. However, another item of note and fun fact for you guys to check with your GPs on is if they are filing composite returns, I would pose the question to them as to why. And the reason for that is composite returns generally do not allow you to carry forward losses. So you'll notice on your Minnesota tax return, you're carrying forward these losses that you can offset income in future years. So while you may owe tax in future years, right, and you still have to file for those years personally, the composite returns don't allow you to carry forward those losses. So in future years, you're going to be subject to that tax. The partnership's going to pay it on your behalf. But it is going to affect your return of capital. So generally speaking, we actually don't recommend that real estate managers file composite returns because of those disallowed losses and losing out on them.
That was new information to me too, so I learned something there.
There you go.
Next question is, what are K3s that we get from some?
Yes. So Nick and Elaine do not have any foreign investors in their partnerships. So you'll notice there are no K2 or K3 attached to your K1. However, K3 is attached when the partnership has a foreign investor. It was introduced approximately a year ago. And it's similar to those state K1s that I pointed out, where if you're not a resident of those states, it doesn't matter. K3 is very similar. If you're not a foreign investor, that information is not going to be relevant to you so long as the investment is held here in the United States. So if the property is held outside of the United States, that might be relevant. But a lot of times what we're seeing is if you just have one foreign investor, the partnership is distributing it out, that K3 out to every partner. It's creating a lot of confusion, but odds are it's not applicable.
Good question. Our next question is a little long. I'll read it here. In part 3 of Schedule K-1 1065, typically line 20 tends to include codes like Z, AG, AH, etc., with STMT instead of the amount next to it. The attachments to K-1 do include amounts for code AG that can be entered into tax software directly. However, for codes Z and AH, the tax filing software seems to expect a single amount, whereas the Schedule K-1 includes a worksheet with columns such as at risk and not at risk liabilities. Could you elaborate on what these liabilities are referring and how these codes can be entered in tax filing software that expects a single value, or should these values be left empty in the tax software since these amounts match those in part 2 and entered elsewhere in the tax software? If you didn't get all of that, Kaylyn, you can see the chat as well if reading things is easier for you.
Okay, I'll take that one at pieces and hopefully I can cover it all. So I'm going to share my screen again with you to show you this K1, and let's talk about code Z, and you'll notice code N here. I don't have code AG here, and that's okay. You guys can see the K1, yes. Okay, super. Code AG is really only relevant if you're a C corporation. So that's why you're not seeing code AG here on this K1. The only reason that it's going to say statement is because that means there's multiple pieces of information that the software could not combine on one line. So when it says statement, what we call our K-1 footnotes. And so this is the K-1 footnote. Anything past the very first page of the K-1 is what we call a K-1 footnote. And so when you flip down to that K-1 footnote, this box Z, the amounts that you should be adding up are right here: rental income loss, 6128, 2131. So they're broken out on an activity level basis. So every property that is in this fund has separate QBI related to it. And the reason for this is QBI is required to be tracked on an activity by activity level basis. So based on your question, I believe you're using a software such as TurboTax, and this is a little bit of a manual piece for you, but what you'll need to do is go through and add up the 6128, the 2131, the 3473. And just note and make sure that you're pulling only rental income loss and then summarizing that total. And then you would do the same thing, unadjusted basis of assets, which is all going to be the second amount here on these lines. So that answers the first part. Let's see, let's dive back into it. Okay, at risk and not at risk liabilities. Without getting too nuanced and boring you all to death with Q&R, non-recourse, recourse. Recourse and qualified non-recourse are considered at-risk liabilities. So I'll say that again: qualified non-recourse and recourse are considered at-risk liabilities. Plain Jane non-recourse on your K-1 is not considered an at-risk liability. So
Very good. A couple of good questions here. So in box L for current year net income would be the distribution we received. Question.
not quite. I'll share my screen again. And let's zoom in on that. Okay, so we've got contributions, we've got distributions, which none were applicable this year. And then current year net income loss is going to pull directly from the right side of your K-1. So current year net income loss is what is taxable or non-taxable to you in the current year. So you'll notice this 33,753 is the same amount that is up here in box 2. So that's just your income or loss that you were allocated throughout the year that's going to drive your capital account up or down.
Then you can leave your screen up here because that goes right into our next question. This is a really good one because it's a common misconception with investors. So this is great to clarify this. In your example, on a 100K deposit, the loss on the K-1 says negative 33,000. Does that mean the investment has lost 33%?
No.
No. I would be horrified and not here talking about this. I would be out fixing big problems.
Yes, yes. No, so your K-1 is purely what we call tax basis. That has nothing to do with fair market value. So this is purely tax basis. Depreciation benefits are driving a lot of this, and depreciation is what we like to call a phantom expense. It's not something that was paid out of the fund. It is truly just a freebie, really, that the government gives you. I mean, take advantage of it. They don't give that many, right? But it's just a freebie depreciation. So it's not a true expense. That's driving a lot of these losses in real estate partnerships. But again, no, this is tax basis. It has no indication of fair market value.
So we want the value of the buildings and the bank account to be as big as possible. But ironically, we want this number to be as negative as possible because that's the most tax advantageous. And this comes from depreciation, which is all just numbers on a spreadsheet from the cost segregation studies. But a common question that comes up, because it can look a little scary of, oh my gosh, if you had a negative number from, say your salary, what does that mean? Does that mean that you're paying your employer because they're running out of money? Whereas a negative number on a K-1 is generally a good thing if it's coming from depreciation.
Right. Yes.
Good question. This is a good question, and I'm going to add a little flair specifically for our hold period. Can you tell us what happens with depreciation recapture on the sale? And then, Kaylyn, a question I get is, let's assume there's a 25-year hold period. Does the hold period impact depreciation recapture at all?
Yes. So start with the first piece of that. What happens with depreciation recapture on a sale? Let's assume, for example purposes, that this 33,000 is all related to depreciation, right? and we go and we sell the investment. This 33,000, assuming that it is all related to depreciation, all has to be recaptured. So I say it's a freebie from the government. It is in the current year, but they're going to claw it back. And it's going to impact your capital gains. So if capital gains on the sale were $100,000, your portion of the gain was $100,000, you have to add back this $33,000 because you took the benefit up front. And so now we're just offsetting the benefit later, right? And so it's a give and take there. So that's what's going to happen on the back end with depreciation recapture. Now, there are certain nuances due to depreciation recapture. Some is going to be recaptured at your ordinary tax rates, and some is going to be recaptured at, it's up to 25%. So it depends on what your ordinary rates are personally, and then it's going to be capped at 25%. And then any gains in excess of depreciation recapture are just going to be at long-term capital gains rates since the property was held for more than a year. And Elaine, to answer your question of does it affect depreciation recapture, the answer is yes, because those assets that, you know, we've took 5 and 15-year bonus depreciation on, when you've held them for 25 years, the recapture still exists, but it's not going to be at the same rates.
Mm-hmm. Very good. We have a very tax efficient hold period. It's a big part of the reason we created our business model this way. Kaylyn, it is 32 after. There's about 4 questions that are all related to the state treatment of K-1s. Do you have time to answer those? So what we'll say is any questions that were already there, we'll include those, and then be respectful of Kaylyn's time here. These are hopefully pretty quick and easy. If you did not account for K-1 passive losses from previous years, can you retroactively correct that in the current year?
So you cannot retroactively correct it in the current year, but what you can do is go back and just file that one state tax return. So you don't have to file an amended tax return, assuming that we're only talking about a state loss. It's not going to affect your federal return, right? So you can go back and just file one particular state. You don't have to amend everything if it doesn't affect your federal return.
Very good. Why might there be a New York partners scheduled K-1 and a New York corporate partners scheduled K-1?
Yes, because states are very complex and they get to do whatever they would like to do. And they love to just create chaos for accountants is what I like to say. If you are a corporate investor, meaning you invested through an entity, you're going to receive both. The same rules follow. It's not going to be applicable as long as otherwise you have no other ties to New York.
Very good. State K-1s that are attached in the PDF are the states that require it, question mark. If my state is not on it, do I need to do anything?
Can you repeat that one more time?
I think basically what they're asking is, let's say they live in Wyoming and there is no Wyoming paperwork, right? Because there's only like New York and Georgia and some of those others.
Right. Do
they need to do anything?
No, and especially, you know, Wyoming has no state income tax, so you're
I didn't know that. I picked the wrong state.
Yeah, that's okay.
Apparently that's where I need to buy real estate next then.
Yeah, but also, again, talk with your CPA about filing in Minnesota because that's where these losses are sourced to. And so if you want to offset your Minnesota income in the future from the sale of these properties, from income that these properties generate, you will want to go ahead and file in Minnesota now and lock in those losses.
Yep. And then I'll just say again, because I would say this is the #1 question I get, is in your K-1, you know, you've got paperwork for New York, Georgia, a couple of other states. If you live in a different state, you just need to ignore that. We disclose it to you because it was filed in case you live in that state, but you can just essentially ignore that.
Yes.
And we don't own any properties in those states. A lot of people ask, does that mean you have properties there? That means that we have an investor who lives in that state, but we don't have any properties outside of Minnesota and Washington. If I lived in New York State for only part of last year, does my New York State K-1 need to be adjusted on the K-1 form, or do I just have my CPA use the K-1 accordingly based on the months that I lived there?
Yes, so your CPA can subdivide your K-1 essentially. So what your CPA is going to enter into their software is how many days that you were a resident of that state versus a non-resident, and your K-1 will be apportioned at the same amounts. So all that to say, you're in the clear. You don't need to correct it on your K-1 because the software is going to divide it out for you.
This is a person that files their own taxes, and they ask, if I file Minnesota taxes, I report 0 income, but just need to figure out how to report losses for the future.
Yes, so you'll pass through the K-1 that you received that has Minnesota losses on it.
And that's so that you lock those in so that in future years, when we have profit from cash flow and those sorts of things, you're able to have that loss to kind of soak up, is how I like to think of that.
Right.
It's kind of a probably a more complex question, but I must admit I'm quite curious too. For a long hold, say like 20 years, what do the recapture rates become?
That's a great question and something I'm going to have to dive into.
Okay. I know that it's favorable, but I've never heard quite it's like a complicated formula is what I've been advised, that it will definitely be much better than if we sold at, say, year 3 or 5 or 7. Is that a fair statement? You're the CPA, not me. I just hang around you a lot.
Yeah, absolutely. If you sell at year 3, everything that you took bonus depreciation on is going to be subject to ordinary income recapture rates, right? Mm-hmm. And your ordinary rate could be up to 37%. Whereas if you hold for 25 years, right, those 5 and 15-year properties, they're not going to be subject to those ordinary rates. But let's say you sell in year 12, well, the 5-year because remember when cost segs are breaking out by 5 and 15 year. And so your 5-year property is no longer subject to the ordinary, but then your 15-year, it's a complicated formula there because it's at 12 rather than a full 15.
Very good. Question, do I have to file Minnesota state tax even though I don't live in Minnesota? So Kaylyn, I'll let you answer it. I know the answer, but I'll let you speak to it. You're the CPA.
Yes. So like I said earlier, a lot of CPAs will do a cost benefit analysis, right? Because they may charge you $250 or a couple $100 to file in a particular state, right? And so if you only have a loss of $30, it's not worth $250 to file your loss for $30. However, if you're looking at a substantial loss, and I'll leave that to your own discretion, we would recommend filing in the state to lock in those losses. And the same thing on the flip side of that, when you have income, if you're looking at $30 of income, you may just want to chance it, and Minnesota may not ever contact you, or they may contact you and say, hey, we received a K-1 and you owe us $10 in tax, right? So it's just kind of rolling the dice there, and it's your risk threshold, I would like to say.
Good answer. Our last question here is, thank you for providing clarity on the K-1 Part 3 line 20 codes. For the Arizona investment, the funds have been invested in 2 different multifamily properties. In the Schedule K-1, each of these properties are shown as column A and column B with values for QBI, W-2, etc., that I have been entering as 2 separate entries in the tax software. Is this an acceptable alternative to entering it in TurboTax versus combining the amounts like Kaylyn mentioned?
Likely, yes, but I have not worked in TurboTax this year, so I can't tell you for certain. The important part is that your QBI reflects the total value. So QBI should be done on an activity by activity level basis, but at the end of the day, you really want to make sure that your total QBI ties out to what you've been shown on your K-1.
Good question. And push your general partners and your other investments to do tax education for you. I think it's a part of our job to teach you guys how to interpret these forms. So I appreciate Kaylyn being here today. Last question. Does it matter if my name on my K-1 is different from my name on my 1040? So I'm not sure if that's related to a marriage or a divorce or something like that, but
yeah. Nope, you're in the clear. I wouldn't advise it, but we could put Mickey Mouse on your K-1 and the IRS is just going to match it up by your social security number.
Mm-hmm. Something I've seen from looking at a lot of these is, people will have long names, hyphenated names, especially like entity names, trust names can be like 15 words long. And so very little of it actually shows up on the K-1, but it's really that social security number or EIN that matters.
Right. Yeah.
Well, thank you so much, everyone, for the excellent engagement. I think we got to 39 or 40 here, which is really good for noon. Thank you to Kaylyn, not only for holding my hand and helping me through so much all year long, and particularly as we're leading up to K-1s, for working really hard to get our K-1s out. So I just have to brag on Kaylyn that we got our JV and our Fund 1 K-1s out very early. Fund 2 was only because we had a closing on December 28th. So we had to do the cost seg study and the engineer and all of that. So by the time I got the paperwork to Kaylyn, it was, already past the March 15th deadline, and she worked really hard to get everything out as quickly as possible so that if you would like to file your personal tax return, you still have the opportunity to do that before the deadline. And just thank you for making yourself available for this time here today. I think everyone really benefited from it, and lots of engagement, and the recording will go out as well. So it will impact even people that weren't able to make it here live today.
Awesome. Thanks, Elaine. Thanks for having me. And everybody, thanks for joining in. As Elaine mentioned, we think tax education is very important. And I know that sounds lame as we're accountants, and I'm telling you that. But I will throw out a shameless plug. Our firm has a lot of free digital content. So even if you're not a client of ours, we have podcasts, we have blog posts. If you're looking to learn more about real estate investing from the tax side and taking advantage of tax strategies, highly recommend hallcpa.com or Tax Smart Investors, our podcast.
And the Facebook group.
Yes.
Really, really active, really beneficial Facebook group.
Awesome. Thanks, Elaine.
All right. Thanks, everyone. Enjoy the rest of your day.